Have you ever placed what looked like a textbook bulletproof trade only to wick out your stop loss by literally 1 pip right before taking off like a rocket straight to your take profit target? It makes you feel like the market is personally out to get you. Like your account is just a piggy bank for frustrating fakeouts while your balance slowly bleeds out. But that gut-wrenching feeling? It isn't bad luck. It's completely engineered because institutional funds moving billions cannot just slap a market order on their screen. They need massive liquidity, which means to fill their orders. In today's video, we're decoding candlestick and start riding shotgun with smart money. I'm dropping the exact 3-step blueprint that separates a real break of structure from a nasty liquidity sweep, the wick versus body rule that tells you instantly who owns the chart, and a full trade breakdown, showing how to flip these exact fakeouts into clean 1-to-4 risk-to-reward setups.
To see how this manipulation actually plays out live, look at what happens right before the trap gets sprung. Picture watching price chop sideways for 3 hours straight. Clean support at the bottom, clean resistance at the top. It looks like totally free money, right? You wait patiently for the breakout. Price pierces above resistance and you hit market buy. 2 minutes later, a massive, nasty red candle wipes out your stop loss and slams right back inside the chop.
That wasn't a random glitch. You just got wrecked by Phase 1 and Phase 2 of the institutional playbook, AMD, accumulation, manipulation, and distribution. Here's the exact strategy banks run. First, accumulation. Smart money locks price in a tight range to build up a massive juice pool. Buy stop orders sitting above the highs and sell stop orders resting below the lows. They're literally engineering a goldmine of retail stop losses.
Second, manipulation. A violent, sudden spike pierces the range. It baits eager breakout traders into chasing the pump, while wiping out every stop loss resting outside that structure. That gives institutions the exact counterparty orders they need to load up their massive positions. Third, distribution. The trap closes. Price aggressively rips in the real direction, leaving retail traders holding the bag in massive drawdown, while smart money comfortably rides the real move. Once you spot this cycle, you stop chasing the breakout, and you start waiting for the sweep. So, how do you call out the exact candle that proves manipulation is finished? To lock onto the exact moment manipulation ends, you only need 3 specific clues on your chart. Clue number 1, the wick versus body rule. When price aggressively spikes past an old swing high or low, ignore how far the wick reaches. Watch where the candle closes. If a candle pops above resistance with a long, aggressive rejection wick, but closes back inside the range, smart money didn't break structure. They just hunted stop losses. A real break of structure needs a fat candle body closing outside the level. A wick sweep means manipulation is complete and the reversal is primed. Clue number 2, the displacement footprint. Right after that sweep, look for an explosive, high-volume candle ripping hard in the opposite direction. This single candle is institutional footprint evidence. It prints an imbalance, what smart money traders call a fair value gap. It proves institutions have stepped in to push price toward their real target. Clue number 3, the retest protocol. Do not FOMO chase that aggressive displacement candle. Instead, set your limit order right inside that fair value gap, tucking your stop loss safely past the manipulation wick high. Look at the difference. While retail breakout traders panic as their positions go deep red, you're calmly entering alongside institutional volume with a micro stop loss and a sweet 1-to-4 risk-to-reward target. Let's walk through a real setup during a high-volume session like the London Open. Take a classic Asian session range that builds up tight sideways price action, stacking liquidity right above a key level. Right as London opens, you get a violent spike snatching the Asian high. The 15-minute candle wicks 15 pips past the high, but the body closes back below the level. That's clue number 1, the wick sweep. The very next candle is a huge red engulfing candle, that leaves behind a clean 3-pip fair value gap. That's clue number 2, displacement.
You slap your sell limit right at the 50% level of that fair value gap. Place your stop loss 2 pips above the manipulation wick high and target the Asian low liquidity pool. Price retraces smoothly into your entry box, triggers your order without giving you heat, and completely melts straight to your profit target. That's a clean, effortless 1 to 5 trade.
Now here is the deadly mistake that causes 80% of retail traders to blow their accounts with this setup. They start hunting every single lower time frame liquidity sweep they see. If you take a 5-minute sweep that's pushing against higher time frame institutional flow, you aren't trading with smart money. You're stepping right in front of a freight train. The golden rule is to always check your 1-hour or 4-hour chart first. If the 4-hour chart is aggressively bullish, you only take sell-side liquidity sweeps below old lows to buy the discount. When you align lower timeframe manipulation with higher timeframe order flow, your win rate and risk to reward hit the roof. Here is your master checklist to screenshot for your next session.
1. Identify your higher time frame bias and key point of interest close. 2. Wait for a lower time frame liquidity sweep with a rejection wick close. 3. Confirm displacement and retest the fair value gap. 4. Cap your risk at 1 to 2% per trade to keep emotions out of the driver's seat. Now, catching institutional liquidity sweeps is only half the battle. If you don't know how to draw and validate your fair value gaps correctly, you're still going to get trapped on fake pullbacks and invalid gaps. Click the video on your screen right now, where I break down the top mistakes retail traders make every single day and how to fix them in under 5 minutes. Tap it right now, and I'll catch you over there.